I'm Kyle with Fundamentals of Finance, and today I will be uncovering some of the most common things life insurance salesmen might tell you, and more importantly, what they might not tell you. Keep in mind, this is not financial advice and is my opinion only. Before I get started though, let me make two things very clear up front. First, I don't think it's bad to buy life insurance. I just think that in the vast majority of cases, you'll be better off with other things as an investment. Life insurance should be used for its intended purposes, to insure against the risk that someone dies earlier than expected. Second, I don't think that all insurance agents are evil or shady. As with any large group of people, there will of course be some bad apples, but I think the bigger issue is that to a hammer, everything looks like a nail, and to an insurance salesman, insurance is the solution to everything, when in reality, they may not be aware that there are better options out there, or may just work at a company that doesn't offer them. There are many different kinds of insurance with many options, so it's hard to sum them all up in one simple explanation. But let me give it a shot. Fundamentally, life insurance involves you paying to transfer the risk that you die earlier than expected to the insurance company. Let's say you're the main earner in your family. If you die without insurance, the risk is that your family might not be able to maintain their lifestyle. If you have insurance, the insurance company will pay out the death benefit to whoever the beneficiaries are, probably your family in this case, your wife and kids, to help replace the income you would have earned if you had lived longer. Since no one knows when you'll die, the insurance company is taking on this risk for you. But obviously, they're not going to do that for free. So whether it's going through fees, investing the money you put in and earning a return on it that's higher than what they're paying you, or both, make no mistake, one way or another, you're paying for this benefit. You may get an investment return, and they may find ways to make it sound like an attractive one, but that return is pretty much always going to be lower than it could be, because the insurance company is just investing in the same kinds of things you could invest in, but then taking a cut for themselves as compensation for taking on the risk that you die early. So is it bad to transfer that risk and protect your family? No, of course not. But when sold purely as an investment, insurance is often not the best option because of the additional built-in cost. So let's take a look at some of the things you might hear from insurance agents. Fallacy number one. Oh no, this isn't the crap other insurance agents are selling you. This is different. This is a high-powered savings vehicle for building wealth. No, it's not. There are many different kinds of cars. Some are better than others, and many of them are different from each other in many ways, but they're all still cars. Could you use a car to get from California to New York? Sure, but it's probably not the best way, regardless of the kind of car. Flying is better. It's the same with insurance. There are all the kinds of differences between policies, which can be twisted and used to confuse you or make one particular product sound more appealing than the others. And some will be more appealing than others. But fundamentally, they're still all insurance, and if you're looking for attractive long-term investment returns, there are usually better ways to get there. Fallacy number two. Sometimes I'll try to convince you how safe insurance is and how dangerous investing is by going back 100 years to the example of the Great Depression. It was so horrible, stocks were down a ton, 40% of banks shut down, but life insurance companies remained strong and owners of life insurance didn't lose a penny of their cash value. There are many issues with this. First, that period isn't that relevant anymore because there was no FDIC insurance protecting bank deposits. There's a reason that since it came out in 1935, nothing like that has ever happened again. Even in 2008, when large banks like Washington Mutual went under, the Federal Reserve stepped in to save the day and depositors came out unscathed. Second, in the Great Depression, when there was a run on the banks where everyone pulled their money out and a bunch of them went under, do you know why that didn't happen to life insurance companies? Because the life insurance companies just stopped letting people take their money out to protect themselves. Insurance salesmen tend to gloss over that little detail. Fallacy number three. Banks buy billions of dollars of life insurance and they're in the business of money, so it must be a great investment. Again, there are many issues with this argument. Yes, there are things like BOLI, bank-owned life insurance, and COLI, company-owned life insurance that do exist. Essentially, these are used to insure against the risk of key executives dying early, the real purpose of life insurance, and to offset employee benefit costs. These policies are also tax advantaged compared to other things banks are allowed to buy. But here are where the issues start. First, banks are highly regulated, so they're really limited in what they can buy. Are you a bank? Are you severely restricted on what you can buy and how much risk you can take by government regulations? No. So why would you want to invest like a bank? Second, these life insurance policies are usually taken out on key executives. Are you a company with important executives? Whose benefit costs are you paying for? Again, if you're just a regular person and not a company or a bank, then how a company or a bank invests isn't that relevant to you. It's just a clever sales technique to make it sound like a safe, sophisticated investment. But just wait, it gets even better. Fallacy number four. Here's where they will tell you horror stories about investing, about how big bad Wall Street firms are guessing which stocks will do well based on wild unproven theories, as if there's some kind of mad scientist who just picking stocks by throwing darts at a board. But before I address how wrong that is, let's just take a step back and revisit fallacy number 3. Remember how banks are so smart you should invest like them, but now Wall Street firms are dumb and crazy? There's just one problem with that. These are often the same companies. JP Morgan Chase, big Wall Street firm and also a big bank. Bank of America Merrill Lynch, big Wall Street firm and also a big bank. UBS, Deutsche Bank. Need I go on? The other issue with the argument that Wall Street is just guessing which stocks will do well is that it's just completely false. No one has a crystal ball and no one will be right 100% of the time. But I used to work for one of the largest investment companies in the world, and I can tell you, they're not guessing. These companies usually dedicate a significant amount of resources to meeting with company management teams, diving through company balance sheets, and understanding what might move stock prices inside and out. There's no guarantee they'll be right, but they're certainly not just guessing. Also, you could also just buy an index fund, which simply tracks a broad index of companies like the S&P 500 and makes no attempt to determine which companies will do best, either through guessing or extensive research. So no, I highly doubt any of these firms are just guessing, as in flipping a coin and calling out heads or tails in the air. Think about it. If they really did just guess, how would they succeed as a company? Fallacy number 5. Since the 401k was established in 1980, the stock market has gone up over 100x. Or they might say how many more assets Wall Street has. And they'll say that's a huge gain for Wall Street, the 401k, but a huge loss for Americans. This is especially dumb because who owns 100% of the assets in 401k plans? Americans. Regular American people like you, saving for their retirement. Companies cannot invest in 401k plans. They can put money in your 401k plan, like give you extra money for your retirement, but a company cannot invest in one themselves. Investment companies might manage some of the investment options that are available in a 401k plan so they can benefit from the fees they collect, but they're investing on behalf of you, the investor. The gains go to you. The assets are yours, not Wall Street's. Fallacy number 6. Another thing you'll hear about 401ks is that if you're in a lower tax bracket later in life, you win and pay less taxes. And if you're in a higher tax bracket later in life, you lose and pay more taxes. And since most people retire at a higher income level, they're losing the tax gain. Again, this is extremely misleading and meant to trick people who are uninformed about how 401ks work. In a traditional 401k, your contributions are tax-free now, and then you pay taxes when you take the money out in retirement. This is what they're referring to. However, there are 2 types of 401k plans. In a Roth 401k, taxes work the opposite way to solve the exact same problem they're referring to. Instead of your contributions being tax-free now, and then you pay taxes when you take the money out, you pay the taxes now, and then you don't have to pay them when you withdraw the money. So if you think you'll be in a higher tax bracket when you retire than you're in now, you just choose the Roth option. This argument also totally glosses over the fact that another huge tax benefit of both types of 401ks is that your money grows tax-free the whole time, which can be a massive benefit if you're young and can divert those capital gains taxes for decades. Fallacy number 7. The main thing they don't want you to ask about is an apples-to-apples return comparison between the life insurance investment they're trying to pitch you and your other options. Sometimes they'll say it's not apples-to-apples because of the death benefit, which is at least a bit more honest. And other times they'll just try to cherry pick specific time periods and massage the numbers to make the insurance return look better than the stock market return. For the first argument, that you can't compare them because they're not apples to apples, I would tend to agree with that. That's why you should ask them to separate them out. Let's say they're showing you a policy that has all these tax and investment benefits plus a death benefit, and it costs you $500 a month. Ask them to show you how much a policy would be that only had the death benefit. If they do that, essentially unbundling the 2 parts, then you know how much you're really paying for the death benefit, and you can do an apples to apples comparison versus other investments with the remaining amount they're trying to get you to invest. Chances are the amount that is going to the investment portion could generate better returns elsewhere. Where it gets a little disingenuous is when they try to compare returns of insurance in one time frame versus the stock market in a different time frame. For example, they'll throw out numbers like from 1980 to 2013, this policy returned 6%. And in the 5-year period from 2008 to 2013, the S&P 500 returned 0%. Why not do an apples-to-apples comparison with the same time frames? Oh, because from 1980 to 2013, while the insurance policy earned 6% a year, the S&P 500 return was more like 11 or 12% a year. That's kind of like saying, well, one time I made a 3-pointer and one time Steph Curry missed a 3-pointer, so I must be a better shooter than him. When we know that in a shooting competition today, he'd wipe the floor with any of us mere mortals. And then they'll massage the numbers like, oh, and that 6% return, if you were in the 40% tax bracket, that's a tax equivalent yield of 10%, and you don't earn 10% in the stock market every year. True, you don't earn 10% in the stock market every year, but the long-term average has been around 10% per year depending on when you start counting. Also, you might not be in the top tax bracket. Also, long-term investment earnings on investments held over 1 year are taxed at the capital gains rate that maxes out at 20%, not your max tax bracket. And in 2022, a single person would have to make over $459,000 a year to even pay the 20% rate. And one more thing, also, when the quote returns, you have to be careful. On a conservative cash value policy like whole life that pays you a fixed return, you're not likely to get 6% anymore because those returns are tied to interest rates. They used to be a lot higher. Nowadays, it's more likely to be closer to 1 or 2%. Other types of cash value life insurance can be linked to an index like the S&P 500 or invested in professionally managed investments. In those cases, you can earn a higher return, but you're simply investing in something you could invest in elsewhere, but paying higher fees and thus lowering your return potential. Fallacy number 8. The last topic we'll cover is the stuff they'll say about all the great things you can do with your insurance cash value. Often these are true, or at least partially true, but simply presented in a misleading way to either make them sound more attractive than what they really are, or make other alternatives sound less attractive than they really are. Two areas we'll cover here are withdrawals and loans. For withdrawals, the pitch is that they're tax-free since they are treated as a return of principal. That's usually where they'll stop unless you ask more questions, because at this point, it sounds pretty good. Let's say you put in $100K and the cash value has grown to $300K. You can take out up to $100K tax-free. Wow, that's so cool. But what about the other $200K, Mr. Life Insurance Salesman? Oh, well, you have to pay taxes on that. Well, what if I invest $100K in the stock market and it grows to $300K? Well, you don't owe taxes on the $200K of gain, so it's actually no different? Exactly. The next question you should be asking is how long would it take for you to get to $300K from a $100K policy? The answer is probably longer in the insurance policy than the stock market. Another benefit they love to tout is how you can borrow against your cash value. They often pitch loans as if they're free money. You're not taking a loan from the cash value, you're taking a loan from the insurance company, so your cash value can keep growing. How great is that? Oh yeah, and you don't even have to pay it back. Wow, free money with no downside, right? No, not even close. First, insurance policies often have limits on how much of your cash value you can borrow and how high the balance has to be before you can borrow against it. Second, and more importantly, like any other loan, you pay interest to the lender, who in this case is the insurance company. And by the way, if you have even remotely decent credit, it's often at a higher interest rate than you would pay elsewhere. And sure, you don't technically have to pay it back, but if you don't, then that interest rate just grows and grows and grows, which reduces your death benefit until it hits zero. So you've put money in, earned a middling rate of return, borrowed some allowable portion of that, and then ended up giving up your entire death benefit, the main reason for buying insurance, to the insurance company instead of your family. Yeah, great deal. If you don't want that to happen, you do have to pay the loan back, or at least keep paying the interest on it. Oh yeah, sign me up for a high interest loan where I get to pay even more money to the insurance company every year forever, but still never pay off my loan. What a great deal. Alternatively, most 401k plans also have a loan option. You'll have to look in your plan documents to see your plan's limits, but often there's something along the lines of $50K or 50% of your balance, whichever is lower. You do have to pay the loan back, and the portion you borrowed is no longer invested while it's being loaned out to you. But there's no bank or insurance company involved. You pay the interest to yourself. It goes right back into your 401k balance. Of course, you probably wouldn't want to take money out of your 401k before retirement unless it was a true emergency, but that can often be a better option than taking a loan from an insurance policy and paying the interest to someone else. In the end, there certainly are legitimate cases to purchase life insurance, but the vast majority of time, it's best to only use insurance to do what insurance is meant to do: protect against the financial risk of dying early. While I can't give you personalized advice, a combination of term insurance and regular investments is often a better solution for most people in most situations. I'm not saying it's never a genuine recommendation with your best interest at heart, but you should know that cash value life insurance often pays a nice commission to the person selling it, higher than most other things. So if you do speak to someone trying to sell you cash value life insurance, which can also be called things like high cash value life insurance, whole life insurance, universal life insurance, or other similar terms, it's best to seek a second opinion from a fee-based financial advisor or financial planner before buying. Also, if you've heard a sales pitch that sounds attractive and wasn't covered here, please leave it in a comment below and I'll either respond to you directly or make another video on it. And if you really want to learn how to invest, Check out my free investing workshop below called The 9 Habits of Successful Investors. The link is in the description below. Thank you for watching, and I will see y'all in the next video.